Section 1. Cost of goods sold. It's not about selling your soul, yet. Written by John Oliver from Last Week Tonight with John Oliver. Welcome to the thrilling world of accounting, where numbers dance and spreadsheets rule. Just kidding. It's about as exciting as watching paint dry, unless of course we're talking about cost of goods sold, or COGS. COGS is the lifeblood of any business that sells products. It's the cost of everything that goes into making those products, from the raw materials to the labor that magically transforms them. Think of it like this. You're a brilliant chef making the world's best chocolate chip cookies, because who isn't? COGS is the cost of the flour, sugar, butter, chocolate chips, basically, everything but the oven and your toque. Understanding COGS is crucial to running a successful business. It's like trying to drive a car without a gas gauge. You might be moving, but you're headed straight for a breakdown. Section 2. What is COGS? Unraveling the accounting mystery. COGS is simply the direct costs associated with producing the goods a company sells. This includes direct materials, the raw materials used to make the product, like the flour, sugar, and chocolate chips in our cookie example. Direct labor, the wages of the people who physically make the product. In our case, that's you, the master cookie baker. Manufacturing overhead, other costs directly tied to production, like the electricity bill for running the oven. It's important to note that COGS doesn't include indirect costs like marketing, rent, or those questionable office snacks your coworker keeps leaving in the break room. Those are called operating expenses, and they have their own special place in the accounting circus. Section 3. COGS, calculation. It's like baking a profit cake. Calculating COGS is like following a recipe, only instead of delicious cookies, you get a slightly less delicious but equally satisfying understanding of your business's financial health. Here's the secret formula. Beginning inventory plus purchases minus ending inventory equals COGS. Let's break it down. Beginning inventory, the value of your inventory at the start of a specific period, like a month or a year. Purchases, the cost of all the raw materials and other goodies you bought during that period to replenish your inventory. Ending inventory, the value of inventory you have left over at the end of the period. Subtract the ending inventory from the sum of the beginning inventory and purchases, and voila, you have your COGS. Example time. Let's say you're a small-time entrepreneur who sells handmade scarves. You start the month with $200 worth of yarn, which is your beginning inventory. You buy an additional $100 worth of yarn during the month, which are your purchases. At the end of the month, you have $50 worth of yarn left, which is your ending inventory. Using the formula, your COGS would be $200 beginning inventory plus $100 purchases minus $50 ending inventory equals $250 COGS. Congratulations. You've successfully calculated your COGS. Now go treat yourself to a cookie. You deserve it. Section 4. The importance of COGS, where every penny counts. COGS is a vital cog in the machine of your business. Here's why. Profitability. COGS directly impacts your gross profit, which is the money you have left over after covering the cost of goods sold. The lower your COGS, the higher your gross profit. More money, more problems? Not necessarily. Pricing, understanding your COGS, helps you set prices that are both competitive and profitable. You don't want to be selling those scarves at a loss, do you? Inventory management. COGS shines a light on how efficiently you're managing your inventory. Are you overstocked on yarn? Are those scarves flying off the shelves or collecting dust? COGS can help you answer these burning questions. Essentially, COGS is like your financial GPS, guiding you towards profitability and helping you avoid costly detours. Section 5. COGS versus expenses, separating the apples from the oranges. It's important to distinguish between COGS and other business expenses. COGS only includes the costs directly linked to producing the goods you sell. Other expenses like rent, marketing, and that office dog everyone pretends they hate are not included in COGS. These are called operating expenses, and they're like the annoying younger sibling of COGS, always hanging around but not quite as important. Here's a handy table to help you keep things straight. COGS, operating expenses, direct materials, rent, direct labor utilities, manufacturing overhead, marketing salaries, non-production. Think of it this way. COGS is like the cost of ingredients for your culinary masterpiece, while operating expenses are the cost of running the restaurant. Both are important, but they serve different purposes. Section 6. FIFO and LIFO inventories impact on COGS. Remember those inventory valuation methods we briefly mentioned earlier? FIFO, first in, first out, and LIFO, last in, first out. They're back, and they're ready to party. Or at least explain how they impact your COGS. FIFO assumes that the oldest inventory is sold first. LIFO, on the other hand, assumes that the newest inventory is sold first. Why does this matter? Because the cost of inventory can fluctuate, and these methods can result in different COGS and therefore different profit figures. In a period of rising costs, FIFO generally leads to a lower COGS and a higher profit. This is because the older, cheaper inventory is being sold first. LIFO, on the other hand, can result in a higher COGS and a lower profit during periods of rising costs. This is because the newer, more expensive inventory is being sold first. The choice of FIFO or LIFO depends on various factors, like your industry and your company's specific accounting policies. It's best to consult with your friendly neighborhood accountant to determine which method is right for you. Section 7. COGS and taxes, keeping the taxman at bay. Taxes, the lifeblood of any functioning society and the bane of every business owner's existence. The good news is that COGS can actually help you reduce your tax liability. Because COGS is a deductible expense, a higher COGS generally leads to a lower taxable income. This means you'll owe less in taxes. It's like finding a $20 bill in your pocket, except instead of $20, it's a slightly less exciting but equally valuable tax deduction. Of course, you should never try to manipulate your COGS just to save on taxes. The IRS is like that one friend who always remembers when you owe them $5. They'll find out eventually. Section 8. The real-world impact of COGS on businesses. The impact of COGS on businesses can be seen across various industries. Let's take a look at a couple of examples. Imagine you're a clothing retailer. The cost of fabric, buttons, zippers, and labor all contribute to your COGS. By negotiating better prices with suppliers or finding ways to streamline production, you can lower your COGS, which can lead to higher profits or allow you to offer more competitive prices to your customers. For a restaurant, COGS includes the cost of food, beverages, and even those tiny paper umbrellas that come with fancy cocktails. By carefully managing inventory, reducing food waste, and optimizing their menu pricing, restaurants can keep their COGS in check and ensure their financial health. Section 9. Tips for managing COGS. Saving money, one widget at a time. Managing your COGS effectively is crucial for business success. Here are a few tips to help you keep those costs under control. Channel your inner bargaining champion and try to negotiate better prices with your suppliers. Every penny saved is a penny earned. Don't be afraid to say no to bulk discounts if you don't have the storage space or the demand. Excess inventory is like that fruitcake your aunt gives you every Christmas. You don't really want it, and it just takes up space. Find ways to make your production process more efficient. This could involve investing in new equipment, automating certain tasks, or simply reorganizing your workspace. Keep a close eye on your COGS over time. Are there any trends or patterns? Can you identify any areas for improvement? Remember, managing your COGS is an ongoing process. By continuously evaluating and adjusting your strategies, you can stay ahead of the game and keep your business running smoothly. Section 10, Conclusion COGS, your ticket to financial success, or at least avoiding disaster. Congratulations, you've reached the end of our whirlwind tour of COGS. You now possess the knowledge to navigate the exciting world of cost accounting without, hopefully, falling asleep from sheer boredom. Remember, understanding your COGS is essential for making informed business decisions, setting competitive prices, and ultimately, achieving financial success. So go forth, embrace the power of COGS, and may your profit margins always be high and your inventory turnover even higher. And if you ever find yourself struggling with COGS, just remember, at least you're not trying to explain the intricacies of cryptocurrency to your grandparents. Now that's a special kind of accounting nightmare.